Hi, my name is Stuart Weems and welcome to the Investopoly podcast. Our goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. I know you're going to get sick of me, but I just wanted to let you know Campbell and I are doing a live Q&A podcast, very interactive. You can ask your questions live and we'll certainly answer them or have a go at answering them. If they're hard ones, I'll give them to Campbell, of course. 23rd of March, so not too far away, at 8:30 p.m. You can register. The link is in the show notes. So hope to see many listeners there live. We put a bit of effort into this in terms of getting all the technical equipment to do it all. So we just hope it's going to be worthwhile. But anyway, we'll see how we go. All right, let's get into today's Q&A episode. First question is from Stephen. Stephen gives me some lovely feedback around the podcast. So thank you so much, Stephen, for doing that. So just a bit of a rundown. He's 57, his wife's 50. He'd love to retire today, but realistically be working for another 10 to 12 years. He earns $315. Wife is self-employed graphic designer, earning about $100,000. 2 kids. One's just finished year 12 last year, and the other one's got about 3 years left of schooling at $14,000 a year. Home is in an investment grade location, or at least Stephen thinks it's investment grade. I don't disagree necessarily. Worth about 2.5 with about 1.4 of debt against it. Investment property, they purchased this investment property in 2019 in Brisbane. Great timing for $650. That's now worth 1.3 with a $800,000 loan against it, with potential to develop, build 2 townhouses. Super, they have a self-managed super fund. He says, unfortunately, I'm not sure why, maybe obviously some regret there. It's got a property in it in Sydney worth $700 and a loan of $345. Got $30,000 in cash and $30,000 in shares. Total combined super is $420. And Stephen's got $185,000 of cash and wondering what to do with it. Just for people listening in, one of the biggest sort of bits of information, or most important bits of information that would be great for me to know too. This is not advice, of course, it's information only, but to give you better information is what surplus cash flow is. Stephen doesn't really tell me that. And because that'll give me an idea of, if you've got really strong surplus cash flow, well, maybe I can put that $185,000 to better work into growth assets on the basis that I'm confident that you're going to be able to repay the home loan. But if surplus cash flow is pretty thin, then I'm going to be inclined to say, look, Stephen, put that 185 against your pretty sizable home loan of about $1.4 million because your surplus cash flow is a little weak. And, prioritising debt repayment is important. So I guess in Stephen's situation, or to respond to Stephen's situation, really difficult for me to do that because I don't have surplus cash flow numbers. But with that sort of family income and with the kids getting close to the end of, one's past school, getting close to the end, I'm going to assume they've got a pretty healthy surplus cash flow. And I guess as a sort of assessment of their situation, I had a look at the property in Sydney. I haven't spent any time looking at this property, but just at a glance, looks to be okay. I mean, it's not going to shoot the lights out, but it's worth hanging on to. Like the gearing is worth hanging on to. So you got 400,000 in super. Let's say that does well. Let's be conservative. Total super in 10 years' time might be, say, 800. Maybe $1 million with some gearing because of the gearing, I should say. So that's okay, but it's not going to be enough to fund retirement. Of course, they've got the Brisbane property, so that's good. They can, maybe the first $1 million will fund maybe the first, 15 years, and then they can then sell the Brisbane property. So that is sell the Brisbane property 25 years from now. They'll have heaps of equity. That'll work. So really, in terms of growth assets, notwithstanding that they make additional contributions between now and then, over the next 10 years as well, of course. So I guess, they're probably okay from a growth asset, investment asset perspective in terms of the investment property and super working together to fund retirement. So the only missing piece of the puzzle then is home loan repayments. So Stephen, if you were confident that you could repay that full loan within the next period of time, so the next 10 to 12 years, which is kind of your time horizon to get to retirement, then I would split some of the money and maybe invest in growth assets. So invest into super. So either through a concessional or non-concessional contribution on the basis that you're 57, so you can access super in 3 years' time if you really needed to, like if you retired and you needed to. So that's not a bad, that's okay. And also because you're a high income earner and your wife's a reasonable income earner, investing in personal names is less tax efficient than investing in super. And you've got the investment accounts inside super as well. So it's nice and clean. So if you had a really strong surplus cash flow and thought, no, we can really put a significant dent in this debt over the next 10, 12 years until we retire, then I would split between putting some of your surplus cash flow into offset and some into super to invest in more growth assets. If your surplus cash flow was such that, you projected that it's probably going to require all your effort and focus to repay the home loan over the next 10 to 12 years, then I would just put it in offset account and reduce it. Now, remember, putting money in your offset account is going to save you, 5.5%, 6%. Let's just say roughly, if you look at long-term average interest rates. That's after tax. So you would have to, and that's risk-free. So you would have to earn, firstly, enough to offset the tax. So maybe, 30% of tax. So you've got to earn then, 8 to 9%. And then if you're going to add risk on top of that, because it's not a guaranteed return, you probably need to aim for earning more than 10% pre-tax for you to be better off, for that to be a better option than putting against your home loan. So sometimes people think, oh, look, putting against a home loan, it feels a little bit, it's not aggressive enough. It's not working hard enough. But actually, when you look at the tax impact and the risk-weighted return, I should say, it's pretty good. It's a pretty good focus. And particularly, you've got 1.4 mil of debt and you're both, you and your spouse are in your 50s. That's a lot of debt for your stage of life. So it tends to be a priority to, put cash flow towards it. And because you've done, you made a really smart decision back in 19 to enter into a market that, was primed for, I remember doing a blog at the end of 18, talking about, Brisbane is prime for growth. So, that perfectly played out really well for you. So well done on making that decision. And I guess, the people listening to this podcast and listening to this Q&A, it's a good case study to show that, that one really great decision can move the dial in terms of buying a quality asset in a market that is, primed for a growth cycle. Stephen, that's my answer. It's probably not a very clear answer just because I don't have that surplus cash flow number. But again, well done on making those decisions. You've got yourself into, I think, a pretty good position. If you, of course, the alternate plan could be downsizing strategy for you, Stephen. I mean, you've got a pretty nice home in a great location that's most likely to benefit from very strong capital growth over the next 10 plus years. So I guess one potential solution could be downsizing the family home in the next 10 to 20 years, and then that could be your home loan repayment strategy. If that was the case, well, then you've got to really think about, yes, you might downsize in accommodation size, but are you going to want to move further away from the beach? Because Stephen's pretty close to the beach at the moment, which would provide a lot of amenity, particularly when you're retired. And then secondly, what, would that, downsize in accommodation size, but, what is the value? And would you really want to downsize as well? You live in a great location. Once you stop working, maybe you want to enjoy that location a little bit more. So it's a possible strategy, but I'm not talking you out of it. I'm just saying that we want to really contemplate whether it's practical and realistic. Anyway, Stephen, thanks for writing in. Thanks for your lovely feedback. And hopefully that helps you with your decision making. Okay, next question is from a listener who wants to be called Sydney Sider. So obviously lives in Sydney. 48 and his wife's 50. They've got 2 kids, 13 and 15. Taxable income there's a tax-free component. So I'm going to say about circa 170, just so, relatable in terms of taxable salary, and wife 120. Combined super is roughly 500,000. Remember, they just hit 50, 48.50, split roughly equally between them. The super balance is lower than that would have been because they set up a self-managed super fund with the intention to buy a property within a self-managed super fund. So it wasn't heavily invested for 3 to 4 years. But anyway, they decided not to do that in terms of buy the property inside super. And so they lost 3 or 4 years. And The listener writes they still regret it. Anyway, at least you didn't end up in a substandard property. So it is what it is. Their home's worth about 1.8 with 600,000 left on the home loan, and they'd ideally like to retire in 15 years, so age 65. But they're worried that their super's not going to be sufficient to pay for living expenses, about $100,000 a year in today's dollars. They've been sacrificing a little bit more, but they can save about $20,000 after tax per year, and they're wondering what to do with that. They're contemplating going and buying an investment property on the Sunshine Coast. The property would be negatively geared, and they estimate it'll soak up that $20,000 in after-tax holding costs. They have family that lives close to the Sunshine Coast, and they've been attracted by the growth over the last 5 years, and thought maybe getting into that market might help them ride that wave until the 2032 Olympics. And that pretty much sort of summarises the situation. Sydney Sider, have you not listened to anything that I've said? I didn't like the sentence. I shuddered when I read the sentence. We've been attracted by the growth over the last 5 years and want to ride the wave until or just after the 2032 Olympics. That goes against the rule number one in my book Investopoly, which is play the long game. It's a terrible approach. Sorry to pick on you, but it is a terrible approach to apply. Because what you're doing is making short-term decisions, and short-term decisions never drive long-term value. They invite you to make a mistake. And you can see what happens when you make mistakes, like setting up a self-managed super fund and deciding, no, that's at least you decided before making the potential mistake, that wasn't the right way to go. But you can see what happens. They have compounding impact. Just like good decisions have compounding impact, so do bad ones. Let's talk about the Sunshine Coast and the Gold Coast. Sort of put those two. Sunshine Coast a little bit different than Gold Coast. Admittedly, Sunshine Coast has a little bit more of a more diversified and sustainable demand. But those coastal areas, in Queensland, they're really interesting markets. They tend to behave differently. They will go through, how I've mentioned previously that property cycles go through flat cycles and growth cycles. Well, those sort of coastal locations are more pronounced cycles. They can be longer and deeper. So that is, growth cycles can be stronger, but also flat cycles can actually end up being down cycles where prices fall, and prices can remain stagnant for a long time in those locations as well. So prices can become overcooked, as in the market value is more than the intrinsic value of the property, and that's where prices get overcooked. And because of that, they'll go through a bit of a correction where prices might come off 10 or 20%. That doesn't mean you can't make money in those markets. It just means that your entry point is even more important than a market that has less volatility. Like capital city markets tend to have less volatility just because the underlying demand is sustainable. The underlying demand in those locations more recently, and this is why Sydney Sider has been so enamored with the more recent growth over the last 5 years. Of course, we've had COVID, which has pushed a lot of Victorians to relocate to Queensland. It was huge. It was a huge amount that did that. But also, in terms of interstate migration that normally comes out of Sydney and more recently Melbourne, but normally out of Sydney, that's where the strong trend is. Most of them are retirees. So a lot of interstate migration goes to the Sunshine and Gold Coast. A lot of overseas immigration goes into Brisbane. And so those markets are fueled in two different ways. So knowing that, I would say buying on the Sunshine Coast or the Gold Coast right now is a more risky proposition. I mean, it just depends on, what you're buying, how much you're paying, so I'm not saying every single property is risky at that stage, but in terms of executing a strategy to complement super in 15 years' time, you don't have enough runway. Like if it doesn't work and you do enter the market at the wrong time, you could end up, spending the next 5 to 10 years funding the negative shortfall, the cash flow costs of this property, and not see much growth. And so you'll look back and go, well, that was a bit of a waste of time. So really the question you need to ask, and I made this point, I think, last week in terms of investment time horizon. Your investment time horizon isn't 15 years, because you want to retire in 15 years. Your investment time horizon is much longer than that, because what you want to do is retire at 65. Hopefully you live to 85, 95, or maybe even beyond. So you've got to fund 20 or 30 years of retirement. Your investment time horizon is more like the decision you make today, you want to really play out 20 or 30 years from now. That's how long your time horizon is. So you want to make decisions that are going to really hit on that target. So, of course, everything in this podcast is always information, not advice. But one thing I would think about, you said you've got a 20-year loan of 600,000. So I take the remaining loan term is 20 years. And so if you just make the repayments, you're still going to have some debt, probably not much, left in 15 years' time when the target is to retire. So arguably, if all we did is made minimum repayments on the home loan and then put all that $20,000 of savings ability somewhere else, arguably that, we might end up with a home loan balance, but it's not going to be a lot in 15 years' time by the time you're age 65. So if those assumptions are correct, what I think I would do if I was in your situation is $20,000 isn't enough, or at least it's very tight to go and buy an investment property. You need to provide for interest rate changes. There's going to be periods of time where there's going to be more maintenance, so the income contracts on the property. You need to build in those buffers. I just don't think $20,000 is enough surplus income. There'll be a whole host of people on social media that will disagree with me, that'll try and sell you a property if you have a $20,000 surplus capacity, but they're selling property. I'm not selling property. I never sell property. I don't sell property. I sell advice. So I just don't think it's enough. So what I think I would do in your situation or toy with is to put that entire $20,000 into super. I would do that on the basis that, you're only 10 years away from accessing super. So yes, it's locking up, but it's locking up in a very tax effective environment and dealing with the issue that, your super balance is lower than it would have been if you hadn't have toyed with a self-managed super fund thing. And even if that means making minimum repayments, that's not a big deal from my perspective, because you can always put future income increases towards the home loan. The kids are 15 and 13. So over the next sort of 5 years, your expenses will go down, schooling costs, these sorts of things equals more surplus cash flow put in the home loan. So I think that even if we put the full 20 into super now, over the next 15 years, you are going to have more surplus cash flow than you have today. And if that goes into the home loan, chances are you'll probably get it down to zero by the time you're age 65. But your focus really should be on growth assets. If your situation was to change where your income, your surplus capacity was much higher for whatever reason, then I would consider potentially that time gearing and going and buying investment property. But at this stage, I wouldn't do it given your circumstances. And prioritizing growth assets or investing in growth assets over debt reduction is important in your situation relative to the listener I just responded to, Stephen, because your debt is manageable. Your debt isn't as large, and it's easily conceivable how we're going to repay that debt, even if we don't focus on it too much. And that's why you can afford to focus on accumulating more growth assets. Anyway, I hope that helps, and thanks for listening. Thanks for your lovely feedback, and I hope that helps with your decision making. Okay, next question is from Glenn. Glenn has been a follower of my podcast and follower of the FIRE movement. So Financial Independence Retire Early is the acronym. And the methodology is to, at its extreme, save and invest as much as humanly possible so that you can accumulate investment assets as fast as possible and retire as early as possible. I mean, that's how I understand it anyway. And just a bit of a rundown of Glenn's situation. He's 38, she's 37. A family income about 300. He earns 270, so most of that. Total super is 840 and total investments about 700. Own a home, no debt, 850. One child that's 8 years old. And spends about 100,000 a year on living expenses, which he mentions he's not as frugal as some fire enthusiasts. So some fire enthusiasts will like try and minimize spending to 100,000 to maximize ability to invest, and can invest $80,000 to $100,000 a year. So pretty strong surplus cash flow and capacity. As I said, they're late 30s and in a great financial position, no debt, very healthy super balances, very healthy investment balances. Let's not forget they're 20 years to accessing super. So 840, that'll be 1.6 to, 3.5 million, 3.5 million is super. So, that over the next 20 years, they've done all the hard work to get all the super into the environment. And now the market will just do its thing as long as they're in a super fund that's going to generate good returns with not too high a fees. Glenn's key question is really around drawdown. So how do you make it work? How do you bridge that gap? How can he work out how much money he needs between now and, being able to access super at age 60? Now, they're going to take a little bit of a sabbatical, I think, but it's only going to be funded through long service leave, annual leave, all that sort of stuff. And then they might work a couple more years and then they'd like to retire. So really, they're projected that their assets outside of super with additional savings over the next 3 years will be worth about $1 million. And they've got 19-year time frame until they're age 60. And so what Glenn wants to do is ask me, how do I work out if that $1 million is enough? Oh, and he wants a $300,000 buffer. So he doesn't want to draw down that money down to zero. They don't want to be so finely balanced that they're almost run out of money at age 59, for instance. They want to build in a bit of a buffer. So I understand that. That's reasonable. Okay, let me start by talking about how we approach this challenge or question for other clients. The first thing we really think about is, the first thing is 19 years is a long time. So you want to think about the components or how you're investing the money, how tax effective it is. So reduce the tax and cost drag as much as possible. How much exposure to growth and protection from inflation do you have? And how much risk do you need to take within the portfolio? So Glenn's actually mentioned in his question that he's not a landlord and quite happy to not be a landlord. And I've had a bit of a challenging past month where every single property that I own has had maintenance requests, and my wife and I are talking about it like last week, saying this property's just a pain in the ass. God, it's just annoying. It's unusual. It's an unusual situation. So I hear you, Glenn. Well done for not being a landlord. Well, I say that facetiously, of course, but in this situation, being a landlord would be very helpful for you. I'm not saying, Glenn, you should go out and buy an investment property, but what I'm saying is that if I had a client that wanted a pool of assets to fund him for the next 19 years, I am more concerned about sequencing risk. I'm more concerned about asset class risk. The share market has done really well over the last 10 years. You might even go a little bit longer than that, 12 or 13 years. Some property markets in Australia have done well over the last 5 years, but over the last 10 to 15 years, property markets haven't done that well in Australia as a general observation. That's, of course, some properties have done well. So that's not always the case as well, because there's certainly been periods of time where property in Australia is going gangbusters and the share market's not doing so well. So that's an issue. So in the situation, I would be much more comfortable if Glenn, for example, had a pool of liquid assets, be $500,000 or $600,000, and an investment property. Because I know I've got the gearing, the compounding capital growth. If the investment property, and this is what we do within a strategy, get the investment property to be as close to neutral cash flow as possible. So it might be a little bit negative, but it's not draining. But the benefit is compounding capital growth. And so we'll use the liquid assets for the first 10 years or as long as we can, and then potentially sell the property in 10 years' time. That'll crystallize or sort of recontribute to, replenish is the right word, liquid assets. And we're at least protected. We've got compounding capital growth. It's tax effective, all those sorts of things. Now, in the absence, so that's the kind of ideal scenario where I'm looking to fund a gap between retirement and accessing super that's quite long. In this case, 19 years. Now, we don't have that luxury in Glenn's case. In Glenn's case, he's going to have $1 million worth of assets in personal names to fund in a share portfolio ETF. And I should say it's split between VAS and VGS, 50-50. My first observation is that have a think about whether you want 50% in VAS, which is Vanguard Australia. Remember, Campbell recorded a podcast just recently. And then this question I received late November last year, by the way. So I am a bit behind. I apologise to everyone for that. But, I received in November, of course, Campbell only just released his podcast. So firstly, you want to think really carefully about, okay, how are we investing? What is the split between income and capital growth over that time? I don't need a lot of income necessarily because I can progressively sell down the portfolio and spread my capital gains, but I'm more interested in absolute return, as in total return, and then also minimizing the tax drag on the portfolio as well. So I want growth. I need growth, and investing in the Aussie market's not going to give you growth. I mean, half of it might be growth, half of it's going to be income. That's not ideal. So thinking really carefully about portfolio construction's paramount. And then also it tells you like how much risk can you take. In your situation, you got a 19-year time horizon for this portfolio. You need to take risk. Like you can't be conservative. It's got to be all growth assets to my mind. The next thing you want to think about is tax drag. So how are these investments owned? Because we need to make an assumption of what our pre-tax earnings will be, and then we need to impute or calculate what our post-tax earnings will be. In Glenn's case, the vast majority, almost 90 whatever percent, is in his wife's name. That's okay at the moment because she's the lower income earner, but not going to be okay when they both stop working. It's not ideal to have all the assets in one person's name. So Glenn, over the next 3 years, your contributions towards your investments over the next 3 years, why don't you put them in your name? So at least then you try and, okay, in the short term, over the next 3 years, not ideal because you're a high income earner. But, over the subsequent 19 years, it'll be better because at least you're spreading the tax burden a little bit more. And then in that first year of retirement, that first full financial year of retirement, maybe then have a think about, are there any parcels that you've purchased in your wife's name that you can transfer into your name? So where her cost base is relatively high because it's a recent purchase, can we then try and balance that portfolio? And that'll reduce the tax drag. Now, I've said before that long-term returns around 10%. If you look at most indexes, whether it's the Aussie index, the global, S&P 500, European StockX, whatever it is, if you look at over very long periods of time, multi-decade periods of time, returns are around 10%. Might be 9.5, 10.5. It's sort of in a tight band. So that's what we can probably expect depending on how Glenn invests, and particularly if he puts more in global markets, and particularly if he maybe moves away from traditional market cap indexing, because this is portfolio construction here is really important in Glenn's situation because you want to capture the returns that are available to anyone that understands indexing. So you don't need any special talent to capture these necessarily. You need talent to construct a portfolio, but you need to capture those returns. And I'm not sure, and this is going to be a key success factor because if he can get a return of 10% versus 7%, it moves the dial, if you like. Okay, so normally I said 10% is long term, but of course we need to think about sequencing, volatility, these sorts of things. So typically I like to do my numbers on 7%, 7% in terms of pre-tax. If we can then balance up the investment ownership between Glenn and his spouse, maybe not perfectly 50-50, but get it a little bit more balanced, maybe we might shave off 0.5% for tax liabilities. Remember, most of the income they're going to receive will be fully franked off the Australian portfolio. So, there'll be some tax credits there. So let's go 6.5% as an after-tax return. I model that out and project it just like Glenn shared some calculations. He did the same sort of thing. But what Glenn didn't do, just for Glenn's specific information, he didn't index to CPI his $100,000 worth of spending, and that's important to do. Anyway, I work out that his portfolios, he's going to run out of money after 13 years, 13 to 14 years, somewhere around that sort of mark on those sorts of assumptions as 6.5% in terms of returns. So if we're going to take that approach, which I think is a pretty conservative approach, which says, I'm going to aim, and evidence tells me I'm going to get probably 10% over a 19-year period on average. Again, not every year, but I'm going to do my numbers on 7, actually 6.5 post-tax. So pretty conservative. You would have a high level of confidence that approach is going to work, or those assumptions, I think, conservative enough to make sure it's going to work. So I worked out he needed 1.4 million. So I guess if we want to enter into early retirement and be in a position where we have a high level of confidence and we don't need to take any silly risks, then my answer to Glenn is you need to work longer. You need to accumulate that 1.4. Of course, the deeper you get into it, the shorter the time period, right? So if he works for another 3 years, then we only need to fund 16 years until age 60. So those numbers are going to move around a little bit, but that's generally what it is. The other way to look at it, and you should do both these numbers by the way, is back it in. What return do you need off $1 million to last 19 years? And the answer is post-tax more than 10%. Slightly more than 10%. So if you got 10% after tax, you'll end up with $50,000. Actually, no, you'll run out of money. So you actually need, if I change it to 11, it'll move the dial. Yeah, you need 10.5%, and that'll get you there. So then the question is, can you early retire in 3 years' time on $1 million and be in a situation? What is the chances of getting 10.5% on average over the next 19 years? I would say that the chances, it's possible, but I wouldn't be banking on it. I wouldn't be building a strategy. I wouldn't be confident enough to say, yeah, retire in 3 years' time, you'll be fine. It's just too high, I think. It's too aggressive. So I think the answer for Glenn, and for people that are sort of playing around with this sort of approach on how to kind of work it out, I think the answer for Glenn is that it sounds like he needs to work a little bit longer or reduce spending. So, maybe it's fine to retire in 3 years' time, but the compromise is to reduce spending to $80,000 a year. That'll get you pretty close. That'll probably work. That'll get you pretty close. Or work longer, as I said, work another couple of years. Probably only needs to work another 1 to 2 years, I reckon, because that's another year's worth of compounding and another year's worth of savings. So I reckon he's pretty close. But, for people trying to work it out, it's really about working out, okay, what is a conservative assumption that I have a high level of confidence with? And what does that tell me? So that's sort of your lower end of the scale. The upper end of the scale is, what return do I need to earn? And how confident am I with that? And then the other considerations to think about is, okay, I need the longer the time horizon, so the gap that I'm funding, the more growth assets I need and the more confidence I need where I'm going to get compounding capital growth. So how I'm investing is a very important consideration to the assumptions that I'm using in terms of sequencing and returns. And remember, what I'm doing here is I'm thinking about, well, if I invest in emerging markets, there's some emerging market ETF funds that, I previously talked about that are trading on 12 times PE ratios. There are, some markets indexes in Europe that are also trading on very conservative forward PE ratios, maybe 14 times, so forth. So don't forget, my starting point, that when I'm constructing a portfolio like this and when I'm thinking about the assumptions I'm making around future planning, I'm thinking, okay, I'm investing in these markets and I'm buying cheaply. My entry point is cheap. So I know then when there's market volatility, my index will fall by less than the general market if there's volatility. Plus also the chances of better medium-term returns, so returns over the next 5 to 10 years, are much higher because of that mean reversion outcome. And so it's important to consider the portfolio I'm constructing and how it's constructed and how it's invested at the same time as looking at the assumptions. Those two things go hand in hand. I can't do this analysis without understanding kind of how I'm investing. And the last piece of the puzzle is then to think about tax. And also, ultimately what you want to do is project forward what your ownership structures look like when you first want to retire at age 60, when you can access super, and then how they behave longer term. And if you find concentration risk, so if you find assets are ending up being consolidated or concentrated in one taxpayer's name, whether that's, company or individual or whatever it might be, you might start thinking about whether that's appropriate and kind of course correcting a little bit in order to sort of accommodate that risk. Great question, Glenn. Thanks for asking. It gives me an opportunity to sort of talk through this analysis and sort of our approach to it. Hopefully that's been helpful. Of course, it's possible that other advisors take different approaches. I'm not sitting here saying this is the one and only, but certainly the way we take an evidence-based approach to these sorts of decisions. Okay, today I'm going to be on the Money Puzzle podcast, which is the Australians podcast. James Kirby and I are going to talk about the almost certain capital gains tax changes. And I prepared a very deep analysis on this, which I'll be discussing tomorrow in my podcast, and which I'll use that material for my discussion with James as well. So we're almost certain going to get some capital gains tax changes. Maybe they're only going to apply to property. Maybe they won't be grandfathered either. So, what does that all mean? And to what extent will it impact the attractiveness of property investing? That's what I'm going to talk about tomorrow. Just a quick reminder to register for the live Q&A podcast on the 23rd of March. Link is in the show notes. Until tomorrow, bye for now. And before you go, if you enjoyed this episode, please share it with someone that you think will get value from it. And if you have a moment, leave a rating or review on Apple Podcasts or Spotify, as it really helps more people find the show. If you have a question you'd like me to answer in the next Q&A episode, email it to questions@investopoly.com.au. And if you'd like to learn about my new book, Wealth by Design, which is out in a few months' time, head over to investopoly.com.au/book. The link is also in the show notes. And you can also register for the pre-order offer, which is an AI tool that you can use to get more personalized value out of this podcast. Thanks for listening.